Hey everybody, Taylor Lyles with the Greenville Home Builders Association, and this is the Think Big podcast. Good morning and welcome to the Think Big podcast. I am Taylor Lyles, the CEO of the Home Builders Association, and I am excited to have you back for another edition. Today we've got a super special guest. We have got Chris Harrison, Dunean Capital Group, and former county council member. Chris, welcome. Thanks for being on.
Glad to be here. Thanks for having me. It's going to be fun.
Yeah, listen, all of them are fun.
Absolutely.
Every single one of these we've done so far has been unique in its own way.
Well, you said you're going to enter your channel your inner Joe Rogan, so that's what I'm excited about.
Exactly. Well, we don't have cigars and we don't have bourbon, but it is also early. But they don't know what's in the coffee.
That's right. That's right.
So, Chris, kind of start us off. Tell us a little bit about you. Tell us a little bit about Dunean.
Absolutely, happy to. So I'm a Greenville native, which I know now I guess is kind of becoming a little more rare. Born and raised here, and I've had a lot of different. Been in real estate my whole career, kind of different capacities. I was in a commercial appraiser for a few years, a little planning background right out of Clemson. But for the past few years, been in the brokerage world for a while, and then about 2.5 years ago. We formed Dunean Capital Management. So it is a real estate investment firm. We're 7 strong right now. We've got myself and 2 other partners run it, and we're an investment firm. It's just like it says. So we acquire value add properties throughout the Southeast, really. Carolinas and Georgia mainly, but we're open to opportunities all across Southeast. So we find opportunities. We raise the capital. We buy them, and we try to add some value to them and sell them, and the goal is to make everybody a bunch of money at the end of the day. So
listen, the goal for everybody is to make more money.
It's a simple goal.
And it's clearly been successful in 2.5 years.
We've had a lot of success. We're blessed, and I'll say we got a great team, and we have a lot of background. So kind of give you a quick backstory. So we've been investing for probably 10 to 12 years. Personally, syndicating deals, having friends and family partnerships. And we really started out buying single-family rental homes. That was kind of our intro into the investing world. And honestly, we didn't have really 2 nickels rubbed together, 10, 12 years ago. So it's a little easier barrier to entry investing in that product type. And so that's how we started. But kind of at the same time, we were in the brokerage world. So we were kind of brokering larger commercial deals, different asset classes. So we were learning the behind the scenes, if you will, from the investment standpoint on those types of assets, while we were learning the getting our hands dirty in the investing world on the single family side of things. So we kind of grew that business, and really it really had a lot of success. We were kind of buying in bulk really on the single family world. And sometimes we would sell to end users on the back end. And so that model really stuck with us. And so for the past, we were doing that for a decade, really kind of growing that side of our business. And then we realized, again, it was about 2-3 years ago, that it was time where we needed to make this full-time business, because we had the skill set, the bandwidth, the resources, the experience now. Kind of, had seen a lot, learned a lot, and honestly, just from a back end standpoint, managing investors, investor relations, reporting to investors, kind of that back end infrastructure in the investment world, something we really wanted to kind of ramp up and grow. So again, for the past, even before we started Dunean, we were starting investing in more commercial deals, larger deals, and so now at Dunean. Again, we're able to really accomplish effectively any size deal. I mean, there's really no. It can be a small deal. It could be a very large deal. We've kind of got that capacity and the skill set, so to speak, to be able to handle really any size deal. So that's what I'd say our secret sauce is our flexibility. We're able to kind of be flexible on the structure of a deal, structure of a fund. we've had a lot of experience in different asset classes from my background, my partner's background. We've invested and dealt with a lot of different asset classes. So we're not really a one-trick pony, which, again, not to say it's a bad thing if you are, but that's just one of our, I think what sets us apart is our ability to kind of be involved and know what we're doing in a lot of different asset classes. So from residential to self-storage to industrial to land. We're doing a lot of land right now, kind of mini farm investment.
Yep.
So I can touch on that later. But yeah, so we've had a lot of success in 2 years. We've got about 5 active real estate funds currently. We've got about 125 million under management. So we're growing, and we've got a lot of opportunities in 2025. So we're excited.
That's great. So Chris, just for the listeners,
Yep.
Let's talk about what a small deal looks like, and actually quantify that in
Sure.
a number. What is a small deal? What's a large deal?
Yep, and there's 2 ways that we look at it. So the way we approach this, our keyword is strategic. So it's either strategic property or strategic capital. So for instance, a strategic property could be a large redevelopment play could be an industrial property that we go in and maybe re-tenant it or add some management capabilities to. And strategic capital could be obviously strategic dollars for a specific purpose. I'll give you an example. We have a land fund currently that's active right now. We partnered with a local RIA firm here in town, and they helped raise the capital for this specific investment strategy. So we didn't necessarily have the properties off the rip. We said, hey, we are targeting this type of investment. They love the strategy, love the projected returns. We showed our experience. We've done these kind of projects before. So in that instance, where we've got the strategic dollars, we go out and find the properties. So conversely, we have a strategic property where, hey, this is a great property. And again, I can give you an example of this. We acquired a 250,000 square foot business park in Columbia earlier or in 2024. And again, it was presented to us. It was a great opportunity. So we had the property. We go out and raise the capital for that. And so the 2 differences is, I would say from a fund standpoint, again, if you have strategic capital, you're going to buy multiple properties. I'd say you're probably looking at anywhere from $5 to $15 million of equity that we will leverage and grow that fund. You have multiple properties in this fund. Again, from a singular deal standpoint, it could be anywhere from, honestly, I'd say on the smaller end for just what we do from a scale and investor standpoint, you're probably in that $1 million range. I mean, we've looked at deals under $1 million from a single deal standpoint, but probably anywhere from $1 million to $30 million. We're looking at a deal right now that maybe even getting up close to 40. So that you know about. So really it's a wide range, but from a singular asset purchase, we're probably in that $1 million to $40 million, and from a fund kind of raising capital for a strategic purpose. Again, we've historically been in that 5 to 20. But again, we have the capacity and bandwidth to go. If we had 50 million, I think depending on the product type and what we're doing in that fund, we have the capacity to go find and deploy that amount of money. It's just depending on all external factors. So that's kind of again, it's a very wide range, but that's putting dollar amounts to it. That's kind of where we have been in our wheelhouse.
So now on your fund, is it set up more like a REIT, or is it set up like a general capital fund?
Kind of somewhere in between. It's a closed fund. So we'll have a raise period where we're raise as much as we can. Usually we like to be in that, again, like I said, really that $10 to $15 million range. Gives us enough scale to go out and buy. And we've structured it different ways. We go out and raise outside capital. We put our own dollars in as well. And we go out and raise capital. So then we go acquire the properties for those types of funds. Again, that's kind of when you have the strategic capital when you're buying for a particular purpose.
Yeah.
So that's kind of how. So they're a closed-ended fund. So usually our term, again, it depends on. There are a lot of variables here, but it depends on if it's a singular asset and what that investment timeline is. Typically, our wheelhouse is that 3 to 5 year investment timeline. Sometimes we'll go out 7 to 10 depending on the strategy, but for the most part we're in that 3 to 5 year window. And everything we like to do, again, we're not our wheelhouse has never been ground up development. So we will partner on a deal. We've been presented some great deals that we've taken a hard look at. Just that's not our forte on the ground up side. So most everything we buy is existing, or if we are our land fund, for instance, we're not really developing. We're kind of creating large mini farm estate lots. You're buying a large acreage tract and subdividing it effectively into 5, 10, 15 acre estate lots, mini farms. So that's kind of the most development we'll do. We'll do some redevelopment. So we're truly value add, buying existing buildings that we see we can bring our skill set, add value to that asset. Again, it could be something as simple as getting rental rates to market over a certain period of time. It could be management capabilities. It could be kind of undervalued, undermanaged properties that we kind of see the value. There's external factors. We may be very high in an area that we know growth is coming to, or anticipate growth is coming to, and so we'll kind of buy in that path of growth. So that's kind of what we bring to the table from our side of things, looking for that investment, the right investment. Again, like we talked about earlier, at the end of the day, to make us and our investors a lot of money. So, and they're structured differently. Sometimes they're preferred equity. Sometimes it's just straight kind of pro rata equity. So depending on the deal, depending on the pro forma and what that return looks like, we can kind of structure a deal. And again, go back to what I mentioned earlier. That's where our flexibility comes into play. We don't have hey, this is how we do it. You're in or out. We are very much, hey, we can be flexible depending on the situation, the deal, the asset type, et cetera.
Let's get real for a second. Are you dumping money into marketing but barely seeing any results? Go Digital can help. Using their marketing matrix, they zero in on your target audience and engage them where it matters the most. Go Digital acts as your full-service marketing team, saving you the hassle and cost of building an entire in-house team or trusting random gurus you found on the internet. It is also important to note that they don't just serve home service businesses. They own one. They've been in your shoes. They know what works because they've lived it. Wondering why I know so much about them? It's because I've been a client for them over a year, and I couldn't be happier with the results. So if you're ready to start winning more leads for less, hit the link in the show notes and schedule a free 20-minute consultation today. That's fantastic.
Where is it?
The cup's right there. That's fantastic.
Have that word facing out. So
yeah, exactly. Well, I always get a hard time. Everybody will listen to the podcast and they'll say, all right, Taylor said that's fantastic at least 11 times.
Well, any good host has a catchphase, right?
Yeah, there it is.
Catchphrase.
Oh,
Boom.
We're gonna sign it and go with it. So kind of back to the investor standpoint.
Yep.
Raising the capital, I know that you've got your pots that you go to.
Yep.
There's a lot of people in this industry that are trying to figure out how to disperse capital. Is there any opportunity for them to come to you and say, hey, I've got X, what can you do with it?
Absolutely. That's where our bread and butter is. Again, we've obviously over the past 10, 12 years, we've developed a good group of investors we go to. But the reality is, for the most part, we are for the most part, I like to call it country club money. Friends and family, country club type dollars that we invest, and it can be people that are in the real estate industry. It could be people that are have completely no idea about anything to do with real estate, and they just they want to get invested in it. So we run the full gamut. We've partnered with a few family offices before, so we kind of get in that world a little bit. But yeah, we're absolutely for the most part we always have something we are looking at raising for or getting ready to raise for. So yeah, we're always open to talking to people and investing. And that's what we like to do, and we're really in it. And we tell this, and hopefully this isn't just a cliche thing to say because we mean this. But anytime we have a new investor, our goal is for no matter the size, that goal is to be a long-term partner, long-term investor. So hey, you invest in this fund, and hopefully 3 to 5 years you make a lot of money, and the goal is you just take that and maybe reinvest into something else we're doing. So trying to really create that long-term value to a client. And I tell folks all the time, we have a lot of real estate folks that invest with us, and I tell all of my real estate friends and people I've known in the industry for years, like, we'd love to have them, and we don't expect to be the only investment they do. We say, hey, share the wealth, if you will. If you want to do some things on your own, great, no problem. If you want to invest with us, we're happy to do that. And we create a kind of hands-off model for an investor. Again, one thing we have really, I would say we've improved on the most, and we're very proud of, is our reporting, our investor reporting. We've got our investor relations colleague. She handles all the reporting, does a phenomenal job. Very detailed, very transparent as far as where your investment is. We've got this is not that this is proprietary. We've got a investor portal that you can log on, kind of real time, where your investment is, what the current value is, all that good stuff. So we try to be overly transparent. So that's one thing we've really, I'd say, ramped up over the past 2 years, is that communication. So because again, when you sign up for a fund or one of these, our job is to kind of manage asset manage and manage your investment. So it is kind of hands off. There's not a lot of folks that have been in real estate, they're used to kind of being in the weeds and kind of making those decisions. So we try to, if they invest with us, again, it is more passive a little bit, but we still try to keep you in the loop and updated as much as we physically can. Any updates, any transactions, sales, leases, etc. So that's one thing we've really, really honed in on, is that communication and transparency with our investors.
I think we've talked about this in past episodes, and truly the key to a successful business is communication.
100%.
I think when you're dealing with anything, whether it's the building industry, whether it's investments, whether it's real estate, whatever you're doing with, it's that communication standpoint. And then you're taking it one step farther by using their funds. So it's not just I'm paying you for a service, it's them having the confidence that you're going to make them money. And what we're seeing, a lot of people are trying to diversify their assets because the market is so volatile, because, Bitcoin and Doge and all that stuff.
Yep.
I mean, Lord, 10 years ago, I wish I had invested in NVIDIA.
Yeah, absolutely.
I wouldn't be here.
Yeah,
I'd be sitting on an island, heavy set, and like running a bar. And I would not wear a shirt at all. Ever.
Pants optional.
Yeah. Let's go shoes optional.
Shoes, there you go. There you go. Yeah.
But I think you just nailed it on the head with communication, and whether it's real estate, whether it's investments, whether it's anything, the fact that you're giving investors that communication, that's key.
You're spot on, and that's really any job, anything in the world. Communication is important, and I'd say especially when you're handling your money, and especially other people's money, and investing in things that is, without trust and communication, you have no hope of succeeding, in my opinion.
Yep. So barrier to entry for Dunean Capital, from an investment standpoint, are we talking 100,000? We're talking 500,000?
Good question. Yeah. So the answer is, and again, I'd like to say, I give the caveat. So, my wife Katie. So she gives me a hard time every time I go into a story or even an explanation on something. I always give a preface or a caveat. So she gives me such a hard time. So I've caught myself. I give a nice long preface before I go into anything, and she just rolls her eyes every time and just gives me hell about it. But so my preface for this is, there's a lot of variables here depending on what we're raising for and kind of the specific asset type and that specific fund or property. But typically, our funds were usually in that 100K minimum, typically. Okay. Not to say that's always the case, and sometimes it may be higher, because timing's a big thing too. We've had several projects, and again, here's my preface. These type of projects that I'm about to tell you about, they're what excite me, kind of the adrenaline rush of having, there's a lot of timing issues with, again, I'll give you an example, the Columbia deal I mentioned that we closed last year. It was brought to us kind of at the 11th hour because it kind of had fallen apart. We weren't involved on the first go round, but to kind of bring the deal back to life, we got a call about it. Hey, is this something you guys would be interested in? And so we had to raise $10 million in about 3 weeks to get. So again, that's not typical, and I don't necessarily love that quick timeline. But for the right deal, and we saw the opportunity, we knew it was going to be very successful, and that kind of stuff excites me. So for that one, just because of the timing and other things, we weren't, it would be too difficult to have, $100,000 investors. So we were kind of had a higher kind of threshold for that.
Of course.
So it's variable, but yeah, typically in that 100K minimum range is what we typically say. But again, we've had some funds where we have lower threshold, and again, I will tell you this, just, I like to think I'm fairly involved and know what's going on in the real estate world, especially in the Upstate. And if you came to us and said, hey man, I got $25K, I'd love to get it into real estate somehow, even if we don't have a specific opportunity for that investment at that period of time, I can 100% get somebody connected with an opportunity that may fit that. So even if it may not be a Dunning fund or a Dunning opportunity technically, happy to help anybody that wants to get into real estate from an investment standpoint. Happy to talk with anybody. So yeah, so there's really no, barrier to entry is virtually just anything. We're happy to help anybody that wants to get into real estate.
Excellent. Chris, I think the statement just needs to be, I'm just here to be a blessing. Yeah. I want to help people create generational wealth.
That's right.
And be a blessing.
That's right. There you go. Well, that's my elevator pitch now.
There we go.
I've got to be careful how I say it though, because hey, what do you do? I'm a blessing. I got to make sure I give a preface before I.
Yeah, exactly. I tell Lindsay every morning. I'm just here to be a blessing.
Yeah, that's right. I'm gonna try that on Katie.
And some mornings she looks at me with daggers. Yeah. So. She's like, well, you're not blessing me much right now.
That's great. That's great. But no, you're right. That's the goal is to create generational wealth. That's absolutely the goal.
So, kind of rolling out of the funding standpoint, let's talk about target properties, target opportunities.
Yep.
Where does Chris Harrison and Dunean Capital kind of see from a growth standpoint? Where are you seeing it?
Good question. So. The past couple years, we have been big. We did an industrial fund last year. I guess we started 2 years ago. But so we did a lot of kind of small bay, light industrial flex properties. We're big on that market. Still think that market is there's some growth there. We typically stayed under that 150,000 square foot range, really under 100, because kind of that when you get to that 100, 200, 250,000 square foot from a warehouse kind of industrial standpoint, you start kind of getting into the REIT world, the big Class A folks, the big boys, if you will. So we kind of stayed below that threshold because that's not our world. From the so that asset, we still think there's growth there. So we're high on that. Still have opportunities that we're looking there. Land, we are big on land, very bullish on land right now, and that is for a number of reasons, but I think in our market specifically, I'm sure all your viewers and listeners know that this area is growing. So, and the Upstate in general, really Southeast, to be honest with you. And when I say land, we like to, again, maybe it's just our simple minds, but we because I mentioned earlier the mini farm play of buying large acreage and path of growth that kind of at that recreational pricing. And then with looking for certain criteria and certain features, you can kind of create this, this demand for these again, we just call them mini farms, gentleman farms, whatever. There's 10 different names for them.
Yeah.
And then, from a governmental standpoint, they're 5 acres or greater, then you kind of exempt plat. So there's a lot of features there that lend itself to being a really good investment product. And the demand for those types of you probably see it all the time in your role. The demand for those large acreage lots, from what we've seen, we really ramped it up in kind of some test case, if you will, some one-off syndications to kind of prove the concept, especially during COVID. And for obvious reasons, it was very successful. And we thought we'd see a little tick down in the demand for those types of products, after everything got back to normal. But it's actually been the opposite. It's continued to tick up from what we have seen in our data and our market kind of analysis. And it's people from in town moving out, maybe 30 minutes out from the city, or it's still people coming from other places, from the west, from the northeast, moving down here for whatever reason they're moving down here for. I think we can guess from a climate and business climate, everything else. So. That product type we're still very, very high on, and like I said, we have an active fund right now specifically investing in that product type. One thing that I personally have noticed, and we're working towards maybe this year doing a fund specifically targeted for this, but essential services retail. Maybe surprising to some, retail has been, in my mind, in my opinion, and from what I've seen, very, very hot and making I don't know if you can call it a comeback, but really, really active right now. And I say that we do have some retail centers and some of our previous funds that have, they weren't fully retail funds. We've acquired some retail properties, and I don't think I'm wrong by saying this. I believe every retail center we have currently in our portfolio is fully leased, or at least has a signed LOI to become fully leased. So it may not be all executed yet, but everything is effectively spoken for. Very few vacancies at all, and really that's that suburban retail that your services that you really can't replace with Amazon. I mean, quite honestly, grocery stores I guess you can, but the grocery anchored centers I think are still good as well. But we love those suburban, you got your pizza place in it. You got your services you see every day that you need to use that you're not gonna order online.
Of course.
And again, another thing I like too is a lot of these retail centers, for lack of a better term, they're mom and pop businesses. I mean, you may have some chains and some franchises, but there are a lot of mom and pop owned. And what we saw during COVID, and even still now, everybody likes the class, the high credit tenants, your big firms. Well, it's really nothing for them to close a location. Our investment strategy is different. We're going to this market. We're just going to close these. And it's really, they can do it with the snap of a finger in theory. I mean, it's a little more complicated than that, but it's easier for them to do. Whereas a lot of the tenants that we have in our retail centers, and what we're seeing being very active from a leasing standpoint, is these, local, regional, mom and pop tenants. Maybe they have 2, 3, 4, 5 locations, or maybe this is their only location. But this is their livelihood. They're not going to just close this store. They're going to do whatever they can to make sure they're paying their rent. Yeah, exactly. So, and that's always been the case. That retail's always been strong. But I think right now, maybe it's from administration standpoint. With the election in November, I don't know the exact calls, but I can tell you retail's been very active. So we're looking right now to kind of take advantage of that in 2025, among some other things.
I think you're seeing retail pop up and I'm a firm believer that retail is going to come back because of the growth that's coming in.
Yep, agreed.
I mean, you've got, I think the most recent number was over 30 plus people a week into the Upstate right now.
That's right.
The Southeast is supposed to see 14.5 million in a population increase and before 2040.
It's crazy.
Everybody's kind of moving in, and I have no problem saying the Southeast is pro-business. They're pro-growth. They're pro-development. They lower taxes. It's kind of a right-to-work state.
Yep.
From that, South Carolina, Georgia, Florida. I know North Carolina is a little different on their working rights, but I mean, South Carolina is seeing this massive increase. You had Scout, which was wild. You've got Project Blackbird, which I'm not sure if we can say the name yet, but I think everybody in the Upstate knows who it is at this point.
I don't know how long I don't know how that works. And now not involved anymore. I don't know. I don't know. But we'll probably have to keep it quiet. But it's a big project.
Knowing that project, what was it? It's 750 plus.
Yeah, over 700 jobs.
I mean, that's incredible. Massive. You know that there's going to be this flock of new construction development going in there, and you've got developers purchasing land there.
Yep.
Key for that is making sure that it's the right price point, which is going to be crucial. Because majority of those jobs, average line workers, 45,000 starting. If you've got 2 people working, your household income's not above 80, potentially, and it's not that in every situation, but potentially you're 80,000. You're capped out at 290 to 320.
Yeah.
So making sure the right product gets built there. And
I'll go one step further to kind of what we were talking about retail, and your members will know this too. Is if you want to call it sprawl, whatever you want to call it, as builders, developers go out further for lower land values, which again helps lower the price of the housing. Well, folks are buying those houses all day long. They're moving out a little further. But the reality is they're doing that because of the cost of the house. They still want to be close to stuff. They still want to be, you still want to be able to drive, within 5 minutes to go get all your essential services. So I think I think it all, it's funny, and I said this, always thought this, that all these things we're talking about, they're all interrelated. It's one big melting pot. I mean,
Yep.
it really is. Everything plays off one another. People think they're kind of siloed off, but the reality is from the economic development, the housing, retail, the infrastructure, everything, and it's not rocket science, but everything plays off of one another. So, so I would argue, to your point, the housing and the price of housing contributes a big part to that. But again, the ancillary services for those residents, not only the jobs, but again, they don't want to be 45. Most folks, I mean, again, we have a few that want to be, but for the most part, they want to be out and have some land and have a nice house they can own and live in and buy, but they still want to be relatively close to things they need on a daily basis.
Still want to be within 20 minutes of that grocery store.
Correct. Exactly.
So I think one thing that we're seeing a lot of is the demographic that works at a Project Blackbird or a Michelin or a BMW or one of your manufacturing facilities. Entry level is that 45. Like that's pretty much set across the board. And that's kind of the average. Now, some are a little bit higher, some are a little bit lower, but from what we've seen, the median salary at these starting out jobs, about 45. So you're right, they're having to get pushed, and they're driving until they qualify.
That's right.
So they're going to Fountain Inn, they're going to Lawrence.
Yep.
So I think, though, what kind of is the driver for all of this, and you're right, it is a melting pot, but new construction and residential development is kind of at the forefront.
Oh, it's the catalyst for sure.
Because if you don't, so I'll give you an example. I grew up in Five Forks.
Yep.
Grandparents had a 7-generation family farm, 750 acres on Woodruff Road. I remember when a section of Woodruff Road going into Woodruff was still gravel.
Yep.
My grandfather had a 81 Datsun pickup truck. They don't even make them anymore. And transmission went out. We had to drive it in reverse on Woodruff Road from Highway 14 back to the house. So about 8 miles.
That's crazy.
We didn't see a single car.
Let's go try that today.
Yeah.
See what
I'm going to pass. Maybe down the median. Builders, trades, realtors. If you're looking for a flooring partner you can trust, look no further. I'm here to tell you about All About Flooring. All About Flooring is a family-owned business with 3 generations of owners that know the flooring business inside and out. They work in residential and commercial projects for both new builds and remodels by providing high-quality customer service and installation for carpet, area rugs, hardwoods, laminate, luxury vinyl, and more. Y'all, they even provide professional carpet, tile, and upholstery cleaning. At All About Flooring, they're more than just a flooring provider. They're your partner in delivering top-tier results that your customers will absolutely love. You can find their website linked in the show notes or visit their 9,000 square foot showroom at 2111 North Pleasantburg Drive. Now, let's get back to the show. But so where I'm going with this is I've watched the whole thing grow.
Yep.
And I've seen what new construction can do to an area. When I was growing up, we got a BILO at Butler and Woodruff.
Yep.
And we thought we were big time. Because we used to have to go to the Winn-Dixie at 14 and Woodruff.
Yep.
And we got a BILO. And I was like, oh, Grandma, we got money. And so it started to trickle down and come closer to that Spartanburg County line.
Yep.
And then we got a BILO in Five Forks.
Big time.
Chris, we were hot to trot.
Woo-wee.
We only had to drive 10 minutes to the grocery store. Then Publix came.
Yep.
And I started looking at it, and then it just started growing. That Scuffletown area, that Five Forks, just started becoming its own unique opportunity.
Yep.
You had stores open up. You had retail open up. You had Lowe's Foods come in.
Yep.
And it just kept growing. We had a gym. So where I'm going with it is if new construction hadn't have been there, none of that would have developed.
100% agree. Because, and what you hit the nail on the head, because that's the catalyst. And I think, we talked about retail and industrial, everything else, jobs, et cetera. Well, especially retail, I mean, for the most part, they're following the rooftops, not even the planned rooftops. They want them on the ground for the most part.
Yep.
So it's not it follows the housing for sure. And yeah, so I think new construction and is 100% the catalyst, and along with infrastructure and some other things. But I think you're right. That stuff isn't there if there's not new construction homes. And what I've seen, not gonna tell all my county council stories, but from what I've seen the past, 4, 8, 10 years, and still ongoing. Like a lot of places, there's that tug and pull on growth and development and job growth, economic development. You've got the folks that say we're good, we don't need anybody else, and then I'm of the belief if you're stagnant, you're dying. That's just my belief, and I could be wrong, but that's my belief. So what's interesting, the interesting thing that I have noticed, to your point, is I think by and large, for the most part, I think job growth, all that, I think we're at a point now in the Upstate that people are coming to the realization that people are going to continue to come here. But I think the big discrepancy now is going to be is where do we target the growth? And I think that's going to be the next kind of big debate. Again, by and large, I think most people have come to grips with, for all the reasons we love Greenville and the Upstate.
Yep.
People are going to continue to move here. We're going to need new homes. We're going to need all this stuff. I think the big debate now is going to be where's our priority areas that we push that growth to. That's going to be the big. I see that as the big butt heads over that over the next 4 or 5 years.
Well, if you look at it and kind of how it's growing, Southern Greenville County is a targeted area.
Yep.
Lawrence County is targeted. Look at the growth in Gaffney and Cherokee County.
Yeah. Yes.
300% up on their permitting.
It's
Gaffney
insane.
Mall is going to be revitalized because you've got 6 developments going in that are 3,000 lots.
I didn't know it was that big. That's a lot of lots.
Monstrous.
That's a lot.
And the infrastructure is there for it because the whole corridor was designed around the mall to handle the traffic. So thinking forward, and then I truly believe give it 15, 20 years, it's going to be a straight corridor full of housing from Charlotte all the way to Greenville through Atlanta. I think the statement is, what is it, Charlanta?
Charlanta?
Yeah, Charlanta.
Yeah. I mean, yes, I agree. It's a thing for sure.
And people want it.
Mm-hmm.
I genuinely think they want it. But I know that one thing that we battle at the association, and I have no problem saying this, is you've got your few people that are natives. Mm-hmm. Majority is transplants, which is perfectly fine.
100%.
I tell every single person that moves here, welcome.
Yep.
I want you here.
Absolutely.
I want you to experience what the beauty is, what the opportunity is. I want you to experience 4 seasons in one day.
Could not agree more. Yeah.
But what I have a hard time with is kind of what we termed as gatekeepers. Last one in, close the gate. I get to experience it, but nobody else does.
We're 35 minutes? You're just starting to get me all riled up now. This is
And one thing that we've battled, and something that we're working on this year, is that NIMBYism. And NIMBYism's not in my backyard.
Yep.
Where the realtor or a sales agent, or they just fathomed it or brought it up in their mind that, hey, that farm right behind this new construction development's never going to get sold, and I get to look at this beautiful green pasture, and that's why I bought a premium lot. The hard part is that's going to develop.
Yep.
When you start to say you can't develop it, you are now affecting that landowner's opportunity that they've been waiting for.
Correct.
Which is potentially generational wealth.
Absolutely.
That is their land. Just because you bought a house and you backed up to it and you love the views, it's going to change.
That's exactly
the
right.
whole thing is going to change. It's like buying on a golf course.
Yep.
And I'll use this example. It's like buying on a golf course and the golf course goes under. Shocking, right?
Oh boy.
It's going to change.
Yep.
If it doesn't get maintained, it's not in covenants. It's not guaranteed to be that. So there changes imminent. Like it is going to happen.
That's right.
One thing that we are working on this year, Minnesota did a really good job with this, and it was a YIMBY program.
Huh.
And it was Yes in My Backyard.
Yeah.
And then I think John even touched on it at the housing market forecast, was YIGBY, Yes in God's Backyard.
Yeah.
And it's churches developing their extra property for affordable housing, because you're seeing a decline in church attendance. So they're sitting there going, I've got land, we've got a problem. But the YIMBY program is interesting. Minnesota did this, and it kind of teed up their Smart Growth Minnesota 2040 program.
Okay.
They started figuring out, all right, we're starting this Yes in My Backyard program, and they start showing what new construction and growth brought to the city and these feeder markets, like our Fountain Inn, like our Lawrence, like Travelers Rest, the whole 9 yards. They had so much success with it, they took it and rolled it into the 2040 program, and they were doing these studies on what is affordable. Affordable should be thrown out. The word affordable should be thrown out. What is attainable?
Yep.
Attainable, for one, is not attainable for all.
Yep.
Because one person attainable is million plus.
Yep.
One person attainable is 120,000. So what is attainable? So they came out with this program, and they brought this idea of a 14-foot wide townhouse product. Everybody panicked.
Okay.
Everybody lost their minds over it.
I can imagine.
Average townhouse in the Upstate's 20 to 22 feet. You get some luxury townhouses, they're 30 and 32-foot wide products. But they proposed a 14-foot wide product. It sold at $189,000. Wow. It met their demographics for that attainable housing.
Yeah.
Sold like hotcakes.
Huh.
So DC took it and they implemented it in downtown DC, where land cost in downtown DC is astronomical.
Sure.
They are selling $100,000 or $220,000 14-foot wide product.
Wow.
So we went up a couple months ago, and I've heard about it and I've seen pictures of it, and you think of 14 feet wide, and you're like, this is a shoebox.
Right.
And this isn't even an adult shoebox. This is a kid's shoebox.
Yeah.
We walked into this product, Chris. I was floored. How well it was laid out.
Wow.
Master on main, 2 bedrooms upstairs with a sitting area. It lived like a 20 to 25 foot wide product.
Huh.
It was stunning.
It's interesting.
So what that YIMBY program did was it started opening up opportunities for people to have the conversation of, all right, how do we fix this?
Yep.
We know that I love the fact that my gym is 2 minutes from my house. I love the fact that Publix is a minute and a half. I love the fact that I've got other grocery store options. I love the fact that I've got restaurants. I've got shopping. I've got everything. And again, we still live in Five Forks.
Yeah.
I did not move far.
Right.
I'm a creature of comfort.
Yeah. Yeah.
Our first house was 1.5 miles from where I grew up. Our house that we're in right now is 3 miles from where I grew up.
I love it.
Lindsay's from Atlanta. She's a lot farther away.
Yeah. That's right.
So the YIMBY program truly started opening up opportunities for conversations on effective fixes. So it wasn't just this, I don't want any more growth. Growth is terrible. We can't fit anybody else. But what it also opened up was there is creative ways for funding on infrastructure from a federal standpoint, from a state standpoint, that we can tap into. So I think one big thing that we're working on is rolling into that YIMBY program and starting it on a small scale and then kind of expanding it. Just to start educating consumers and homeowners, this is what you have at your fingertips because of growth.
I love that. I love that. Solution oriented. I love that because you're always going to have NIMBYs. It's just
of course
always. So I think that's a great strategy. Let's try to grow the YIMBYs, and so if you got a good healthy mixture of both, then you're doing something right.
Yep.
So I think that's great. I think that's interesting.
Yeah. So we're going to roll with that and kind of see how it takes off.
That's great.
I'm excited about it.
I'm looking forward. Yeah, I'd love to hear more about that. That's great.
But
that's great.
before I got off on my soapbox, back to the growth zones.
Yep.
So we know that the feeder markets are thriving right now.
Correct.
We know that Spartanburg County is absolutely going wild.
Yes, they are.
You've got a pro-business, pro-growth county council,
Yep.
and they are thriving.
I've been screaming this for 4 years, and this again. I'm a Greenville guy. Like I'm telling you, and I've got a little bit of, I went to high school in Riverside, so I grew up in Greer for middle school on. My parents lived downtown Greenville, so I've got kind of the downtown and the east side of Greenville in my blood, and so I can feel like I can say this. Being in Greer, you have the Spartanburg Greenville kind of. There's always been that kind of. I don't know if it's a big brother, little brother. I don't know. There's been always this little. I don't know.
It's the wall.
It's
It's the hatred wall.
Yeah, exactly.
That's
exactly right.
You cross into Spartanburg, you hate Greenville. You cross into Greenville, you hate Spartanburg.
That's exactly right. Yeah, it's well said. I'm just telling. I've told everybody till I'm blue in the face. The things that they have set up, and they're actually doing now, from one Spartanburg to just the leadership in general, to their climate, to their honestly to just the mentality of their citizens, of the residents in Spartanburg County. It is all pointing towards they are. I just don't know what they're kicking our butts right now. It's just it's kicking Greenville's butts right now. From a if you look into the whatever you're looking to the future, if you will. They've got a lot pointed in the right direction. Where again, I'm an optimist at heart. I'm a glass half full guy, but from what I'm seeing, Greenville's got some things pointing good. There are several things that are not pointing in that same direction.
Yep.
And so I think they've done some really good. The one Spartanburg group, I can't say enough good things about. I think they've done a phenomenal I think they're job. Phenomenal. And again, Greenville's got the right people and the right opportunities, but I think it's just it's an old dog, new tricks. I mean, kind of getting all these organizations and leaders and groups that they really want what's best for Greenville, but getting them to talk to one another and actually be truly part of one team. It's tough. It's not anybody's fault. It's not like anybody's trying to get in the way of that. It's just Spartanburg has been able to do that. They've been able to get that buy-in, and they have that one group for their city and their county. It's really pushing this. They push the penny tax. Really, I mean, very effectively.
They were successful.
They were successful. We obviously were not. And I hate that because I think that would have been a really good thing for roads in Greenville County. But it is what it is. It was voted down, so that's no problem. But they've done a good job of really getting the message out and kind of coming full circle here. Communication. That's one thing Spartanburg has done tremendously well, and I would say the top thing they do better than, if we're talking big picture of Greenville, is communicate with their citizens, with their residents, with their elected officials, with their leadership, with their different organizations within the county. It's a communication, positive communication, and effective and accurate communication is the big thing. Not just anybody can just communicate, but you got to make sure the communication is accurate.
Correct.
That's kind
of the key.
Not to bash on social media stuff, but there's a lot of communication on social media, but not I would say majority is maybe not accurate, but so they do a great job. One Spartanburg does a great job. That whole region is doing tremendously well. So yeah, I agree with you.
I mean, one Spartanburg, if we could create, and I've been begging for this ever since I became CEO of the Home Builders Association umpteen years ago. Mm-hmm. Feels like forever. Some days feels like eternity. But
we still got a nice full head of hair. See, that's
I don't know. It's starting to go.
You'll know when it gets to you.
It's starting to go. Lindsay reminds me of it. So one thing that I've been begging for is I would love to have just a roundtable with all of the advocacy organizations, because at the end of the day, we're not going to agree on everything.
Right.
We know that. We're pro-growth. This organization is not. There are ways that we can meet in the middle.
100%.
And there are ways that we can say, all right, we agree with you on this issue. Let's meet halfway, because if we go your 100%, then it's going to cause this.
Yep.
There's zero communication between different organizations, and I think that's truly a downfall.
I agree.
And as a former council member, you've got me in your ear, and you've got 3 other organizations in your ear. Well, the other 3, 9 times out of 10, are anti-growth. They don't want it.
Right.
And you've got me over here trying to explain to you how this one issue is going to affect home prices by $100,000. So if we could all sit at a table, I genuinely think that we could make it better.
I agree.
And we could truly add value instead of it being this push-pull, this constant battle.
You're so right. I would have to do another episode of just, it could be memoirs of county council, and I can give you the full story. But the thing that bothers me, just this is in general, I mean, this could be with real estate, with anything. I just, everybody that has some kind of say-so advocacy group, individual, whoever, don't come to it with, hey, I'm just going to tell you, I don't have an agenda, but I'm going to tell you this. Hey, it's okay. That's the thing. Like when you, to your point, when you would reach out and other groups would reach out, different issues moving forward in the past, it's like, I know, and it's okay. I know you're representing your members. You're advocating for them. That's okay. Like, let's not. And you hear another group. Hey, look, don't pretend. Like, don't try to say, hey, I'm just doing this for the good. Like, it's okay if we have different agendas. To your point.
Yep.
Let's be honest. Let's just acknowledge it. Hey, look, I'm fighting for this. Okay, and so I'm obviously never going to agree to X, but we might have some room on Y that we can, to your point, to find common ground.
Yep.
So the whole of like, I feel like we've lost that, and it's just, this is not a Greenville problem, just in general. This is just in life, really, in my view. Whether it's real estate investment, whether it's politics, whatever it is, I think people have kind of lost that. Hey, I disagree, but we can find a common ground. Now it's like, nope, this is how it needs to be done. I'm not going to find any common ground. It's got to be this. So, getting back to that, but like to your point, like everybody's got agendas for the most part within reason. So let's be upfront about it. Hey, what is your ultimate goal here? And then you kind of work backwards, and it can be solved. That's the frustrating part. This stuff can be solved. It's not impossible. It's difficult, not impossible. It can be solved. Getting the right.
But again, it's give and take.
Absolutely.
It is explaining the problem.
Yep.
And coming to a common ground.
That's right.
Which, if anybody's listening and you are working for any other organization, and I hope they are listening.
That's right.
We want to work together.
Yep. That's important.
Do I love battling? Sure.
Yeah.
Do I want to? No.
Right. That's right.
We can continue to make this town the best thing it could ever be and make it truly to its full potential. Yep. But we have to work together.
That's right.
So.
Well said. So I got a lot. We can go.
We're gonna do part two.
Part two. We'll do a part 2 for sure. So
then mark that down. Part 2, Memoirs of County Council.
Part 2. Part 2. That'd be a fun one. We may have to charge for that one. You could probably get a subscription for that one.
Yeah. Well, I love it. It'll be our patron account.
Yeah. Pay-per-view.
Yeah. It'll be cigars and bourbon.
Yeah, that's going to be like a Ron White, the comedian. That's going to be cigar, bourbon. We can tell all the stories there. So this is great.
I love it.
This is great.
Well, listen, Chris, thank you. I truly can't say thank you enough. I greatly appreciate you being a part of this. And I also want to say thank you for your time on County Council.
Oh, appreciate that. Thank you.
For truly fighting the good fight and standing up for what you felt was right.
Thank you. It was fun. It was it was frustration but fun, and it was a good experience. Glad to do it, and I'm still a Greenville guy, so I'll still be around trying to help where I can and do some different things. But I think my colleagues at Dunean Capital they're happy that we can actually maybe get some work done now.
Your full bandwidth is back.
Yeah, my bandwidth is back, and we can jump back into making some investors some money.
Oh, perfect. Well, listen, I want to say thank you to the listeners. You've listened to an episode with Chris Harrison, Dunean Capital. If you have any questions, Chris, how can they reach you?
Duneancap.com is our website, and we'll have some social media. We have all social media platforms. We'll probably post this or whatever, and they can reach out to me directly, and I'll make sure our contact information is on our social media platforms showcasing this. But yeah, Duneancap.com is our website. You can reach out to us there. Be glad to talk to anybody that's interested in getting in real estate.
Perfect. Can't wait to see you on the next episode. Thanks. Thanks for listening to the Think Big podcast. If you can do me two big favors, if you can subscribe to the podcast to continue getting updates whenever new podcasts drop. And also, if you can scroll to the bottom of the page and just give this podcast a review. We want to continue pushing it out to more people, sharing what we're talking about, and educating more people in the building industry. I would also like to say a huge thank you to two of our sponsors, All About Flooring and Go Digital. If you're interested in sponsoring the Think Big podcast for 2025, be sure to reach out to the HBA of Greenville today. Thanks.